This is the September meeting of the San Jose Federated City Employees Retirement System. We will have a roll call in order of seniority. Trustee Chandra, Trustee Orr,
Present.
Trustee Kelleher,
Present.
Vice Chair Jennings,
Present.
and I am present. So we're going to go first into closed session and then do orders of the day. Is that correct?
As far as I know, yes.
Okay,
Yes,
so
that's correct, Mr. Chairman.
okay, so we will. I believe Linda, you will move us individually into the closed session.
Yes, Marty will move you into closed session.
Okay, Marty, I'm sorry. Thank you. resume with the regular meeting then. A few ground rules I need to announce. All votes will be roll call votes. If you are not speaking, please be on mute to cut the background noise. For discussion items, each trustee will have a turn to speak in roll call order, more than once if desired. The public will also have an opportunity to speak on each item after the trustees, and the public will also have an opportunity to speak again at the end of the meeting on any other item not on the agenda that is within the subject jurisdiction of the board. We have some special orders of the day to add today, and I will read them. It is a bit lengthy. Governor Newsom signed Assembly Bill 361 into law on September 16th, 2021, as an urgency bill effective immediately. AB 361 permits local legislative bodies such as this board to continue to meet virtually through telephone and internet means, i.e. via teleconference, during a proclaimed state of emergency without having to meet certain technical requirements of the Brown Act open meeting laws, provided the board makes certain findings. The findings must be voted on and approved at the first such teleconference meeting, and to continue after the initial teleconference, continuing findings must be made again every 30 days thereafter. In March of 2020, the governor proclaimed a state of emergency due to the COVID-19 pandemic, and that proclamation is still outstanding and active. Pursuant to AB 361 and amended Section 54953 of the Government Code, the board will be holding this meeting during a proclaimed state of emergency, and state and local officials have imposed or recommended measures to promote social distancing, including the wearing of masks indoors. The board is asked to make the following findings by majority vote. 1, the board has reconsidered the circumstances of the state of emergency. 2, the state of emergency continues to directly impact the ability of the members of the board to meet safely in person. 3, the board determines that as a result of the emergency, meeting in person would present an imminent risk to the health or safety of attendees. And 4, state or local officials continue to impose or recommend measures to promote social distancing. I'd like to call for a motion to adopt the foregoing findings.
So motion by trustee Kelleher.
And a second.
Second.
Trustee Orr, thank you. Any discussion? Public comments? We'll have a roll call vote.
Yes, Mr. Chairman.
Yes, Harvey?
Chairman. Yeah, thank you. Just a little bit of color on this before the board
Okay.
votes. We should verify, and perhaps the folks at ORS can verify this, that there are still local officials who are calling for social distancing and wearing of masks indoors. It would be good to have somebody just update us on what the state of affairs is officially in the city of San Jose, so that these findings are based on the actual state of the emergency declaration, not just the governor's emergency declaration, but on the facts on the ground in San Jose. So it would be helpful for the board before voting on this to have an understanding of what the conditions are.
Harvey, let me try to address that first. It's a little hard to understand. I think you're cutting off sometimes, at least on my on my iPad. But I think San Jose is kind of doing business as usual. The city council is actually meeting in person in the city chambers, but they are conducting hybrid meetings. In other words, they usually like their staff to be in location to make presentations, but the public have the chance to either attend in person or attend by Zoom. At this point, they plan to continue that approach. I did hear from the assistant city manager this week that given the new or the extended and the new requirements as explained by the chair and by yourself from the governor, that they may discuss that internally and then provide boards and commissions some direction or some information, but for now, it is fine to continue meeting virtually. I don't know if that's what you were asking, but that's where we are.
Well, yeah, as I understand it, there still is there is a declared state of emergency statewide. And I was just inquiring whether there were any further local orders from the health officials or from the city officials that impact on the finding that we would be making that
Understood.
that there's still risks involved with meeting in person, and that they're still recommending social distancing, for example.
Yes, they are certainly doing that. I haven't heard anything new from the county health officer or any new requirements, but I do know the city is proceeding in that fashion. Mask inside, the recommended space when you're inside, and certainly they're keeping with all the CDC recommended requirements. So at this point, I think is nothing has changed.
Well, and the city is also implementing this stage 2 as of
Vaccination, yes.
September 30th of the mandatory vaccination policy. So that's in recognition of the ongoing variants that will be coming forward as well, particularly in the coming winter months that just came out from OER, Employee Relations.
Right. Okay.
And
so
Council Liederman, I believe, at least for the purposes of this meeting, the pre-existing state of emergency continued through September 30th, if I'm not mistaken.
That's correct. The governor actually signed, since AB 361 was adopted last week. 2 days ago, the governor adopted another order that kept his previous executive order in place till September 30th. And then the new law would kick in on October 1st. So these findings will have to be re-upped essentially every time the board meets, if it wishes to continue to meet virtually as it has been meeting. So this will become, and we may be able to abbreviate it a little bit, but at the next meetings and for committee meetings, these findings will have to continue to be made because the new law requires you to continue acknowledging the emergency and the risks to health and safety if we were to meet together. That's an ongoing obligation of the board if it wishes to continue to meet virtually. Mm-hmm. So
understood. I was merely going to suggest that perhaps in time for our next regularly scheduled meeting, that we have a more comprehensive statement from quote local officials on their view of the state of emergency and required measures, and so then we can continue to adopt this motion with greater confidence.
Right. Very good.
Excuse me, Mr. Chair.
Yes.
The council member has her hand up.
Okay, I'm not seeing that, but please go ahead.
Thank you. I just wanted to make sure everyone knew we are continuing I believe it's every 60 days to declare the ongoing state of emergency. And when we're meeting in person, we are only meeting in person so far for open session on Tuesdays. All committee meetings are still happening virtually. And when we meet in person, there is distancing in the council chambers, and everyone who is speaking has to keep their mask on even when they're speaking. So there are some issues with audio that have happened because people are wearing masks even when they're speaking into the microphone. So I just want to make sure that everyone is aware what the procedures are if you do meet in person, and that we continue to renew the state of emergency declaration I believe it's every 60 days.
And Chairman, Ms. Davis, I have a question. So is that written policy, is that a written policy, or is this something that we could find in the city council's minutes or whatnot?
About masking or about the declaration?
No, the masking and the social distancing if you are in the open session in the city council room.
That, I believe that is what the county guidelines are for maintaining masking. And so
Okay.
we're following the county guidelines. I think we got an email about it, but I don't remember exactly.
Okay, thank you.
All right. Thank you, Council Liaison. Any further comments on the motion on the floor? Hearing none, we'll have a roll call vote, again in order of seniority. Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye. It passes unanimously. Right, orders of the day. We will target a short break around the 10 o'clock hour. And of course, we will have a recess from 1 to 1:05 to accommodate the Civic Center TV broadcasting system. I do not believe there's a need to waive sunshine. Staff, please correct me if that's not the case. If not, may I have a motion to accept the orders of the day?
I so motion.
Moved by Vice Chair Jennings. A
I'll
second,
second the motion.
second from Trustee Kelleher. Any discussion? Hearing none, we'll have a roll call vote. Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye as well. It passes unanimously. We will now proceed with the consent calendar. Are there any items in the consent calendar that a trustee would like to be pulled? Hearing none, I believe we don't need a vote on this. We can move to item 2.0.
Mr. Chairman, we need a vote on the consent calendar,
Constant, yes, thank you.
to
My
adopt the
mistake.
consent calendar.
All right. Do we have a motion to accept the consent calendar?
I motion.
We have a motion. Do we have a second?
I'll second that.
I believe we had a second. Was that Trustee Keller?
Yes, it was. Thank you.
Okay. Any discussion? Hearing none, we'll have a vote. Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye as well. It passes unanimously. Now move to item number 2, death and survivorship notifications. Have a moment of silence for those who have served the city and who have passed. Thank you. Item number 3 is an oral update from CIO Palani.
Thank you, Mr. Chairman. Good morning, trustees. Today we will actually, under the investment section, we will be talking about performance. First quarter 2021 for private markets and second quarter calendar year 2021 for public markets, as also fiscal year returns for the plan. But before we get there, I have a few comments that I'd like to make. Firstly, as you know, there's going to be a joint session between the boards and city council on September 30th. And at that session, there was some expectation that I would talk about investment strategy for the proceeds of the POB. And I made it clear that I will be unable to talk about what the boards will do with any POB proceeds for several reasons. One is we don't even know if a POB is going to be issued. And if a POB is issued, we don't know the size, we won't know the structure or the timing, and all of which have a bearing on how we will invest those proceeds. Secondly, I did make it clear that it's the board's decision, it's not staff decision. The board, in consultation with the investment team as well as its consultants, will take decisions that are in the best interest of the plans. And so it's premature to talk about an investment strategy for POBs. There will be one slide that talks about our current asset allocation for both boards. And I will be happy to take any questions from the council and other stakeholders at that meeting on our current investment strategy. So moving on, as you know, the markets have been choppy of late, and this is partly because of China and partly also because of the Fed's comments on tapering. First, to talk about China, as you all know, there's been an ongoing crackdown of tech companies by the Chinese government. Several marquee names have been affected: Alibaba, Didi, Baidu, Tencent, and so on, and even some of the online tutoring companies like New Oriental Education. So that's had a bearing on the Chinese market. And China, of course, is a big part of emerging markets. And we do have a sizable allocation to emerging markets. So that's something that we've been following closely. But more than that, more recently, we've seen the issues with Evergrande, the property company, and some of the ramifications of Evergrande going bankrupt. And so I thought it would be a good idea to actually invite Investment Officer Christina Wang, who's our expert on public equities as well as China, to address the boards and to talk about what's happening in China, especially as it relates to our plans, our exposure, and so on. So without further ado, let me invite Christina to talk about China, and I'll come back and take any questions.
Great, thank you, Prabhu. Good morning, everyone. Let me share my screen. As Prabhu just mentioned, lately we have observed some volatility in China and in Chinese stocks specifically. So I wanted to take this opportunity to update the board on our China exposure in public equity, our managers' reactions, and our outlook in emerging markets. So our emerging markets target allocation is 12%, and which implies a little over 4% allocation to China. So it's quite significant here. Fiscal year to date, this was as of 9/14 last week. We've seen a huge dispersion between the performance of US equities versus emerging markets, especially China. And as of 9/14, from June 30 to 9/14, Russell 3 returned 2.7%, while emerging markets was down over 5%. And especially MSCI China is down more than 14%. So the spread between US and China is more than 17%. And I just quickly checked as of yesterday, the spread has widened to over 20%. And as Prabhu just mentioned, a series of macro events have caused uncertainty and driven the volatility in Chinese stocks. It's primarily, though, centered around a few themes. One is the tension between US and China. And then also there's a lot of macro events happening in China. The government investigation into antitrust, their cybersecurity concerns, and their concept for common prosperity. There was an overhaul in the education sector, and finally, over-leveraged property companies needs to be addressed in China. So we don't have a dedicated China manager, and our Chinese exposure is largely through our emerging markets managers. This is their allocation to the country as of quarter end. The Federated Pension Fund has about 3.4% in China, which represents the underweight relative to our benchmark. All the emerging markets managers have negative relative exposure to China. In this chart is the gray bar. We can see that majority of the managers has underweight, and all the emerging markets managers have an underweight to China. So for different sectors, managers take different approaches. It's almost consensus that education sector is not investable. They exited the sector even prior to the crackdown. some managers took the opportunity to purchase large internet tech names, but majority of the managers are cautious at this point, and they may take the opportunity to incrementally add over time. The active managers appear to be well positioned entering into this turbulent period. This is a quarter-to-date manager return as of last week. Majority of the managers have outperformed the benchmark despite a challenge we're seeing in the general market. And this is in the brown bar that we are seeing. Almost all the emerging markets managers have had a positive return. And we're hoping that active managers can add value through this period. So external managers and our investment staff are cautiously watching the developments of the macro policy in China, and we will maintain the underweight for now. We see opportunities in small cap and mid cap companies and in certain sectors. We agree with the manager's positioning, and we will continue to monitor the developments of China market. So this concludes my presentation, and I'm happy to take any questions and address any concerns you might have with this country.
Thank you, Investment Officer Wang. Are there any questions from trustees?
That was very helpful.
Thank you.
Yes, thank you. I think this is an important area of focus. The government in mainland China has taken some recent moves that seem to be quite hostile to investors, and it's something we need to be aware of. A couple of quick questions. You showed the asset allocation to emerging markets and then to China as 4.1%, I believe, on the original slide, but we don't actually set a China equity allocation. So is that simply reflecting that a third of emerging markets universe is China?
That is correct, Mr. Chairman.
Okay, so being underweight does not violate our asset allocation anyway. That's entirely within the purview of our investment staff to make that judgment.
It's really from our active managers' judgment call. So they have the discretion of allocating in other emerging markets, countries, or in China, and some of them has reduced dramatically over the last several months. So that reflects a 3.4% weight to China, which is an underweight.
And these numbers reflect our public markets exposure to China. Do we have much, if any, private market exposure in China?
We might have a little bit. I was talking to our investment officer the other day. For example, some of those private real assets or venture capital managers, they have one or two names in China, but it's much smaller than our public equity exposure here, because it's a 4% to the overall plan.
Mm-hmm. Okay, thank you. Any other questions? Any questions from the public?
Just a comment that I appreciate the update in this timely fashion around China, and I'd like to see things like that, whether it be India or whatever thematic, come to the table again in future. This is very helpful. Thanks.
Thank you.
Yes, thank you. I think it was extremely both timely and helpful, so we appreciate that. And returning to the item 3A, is there anything further the CIO would like to advise us of?
Yes, thank you, Mr. Chairman. Thank you, Christina and Trustee Orr. That comment is duly noted, and we will, of course, bring other thematic issues in front of the board. And with regards to China, you'll all get to revisit our strategic asset allocation, which typically commences at the end of this calendar year, early next calendar year, barring anything unforeseen in the market, of course, in which case we may do it earlier. But if not, that's when we will revisit our strategic asset allocation, and we'll get a chance to talk again about our allocation to emerging markets and so on. We are long-term investors, and emerging markets continue to be one of the few asset classes that have capital market assumptions in excess of our discount rate. But as the chairman pointed out, the Chinese government has been making some moves that do cause us some concern. So that's something that we should be tracking. Mr. Chairman, before we move on to the private market report by Newberger, I just want to let the board know that we do have some preliminary numbers for this current fiscal year. As of yesterday, pro forma performance for the pension plan, it's up 79 basis points, 0.79%. And of course, I'm watching the ticker today, and a few more days like today, we will actually be all set for this fiscal year.
Perhaps you'd like to represent at the end of the meeting.
Yes, I might do that.
Okay.
So with that, Mr. Chairman, unless there are any questions for me, I'm happy to take any questions. And if there are no questions, I would like to invite Ms. Casey Boyer from Newberger.
Any questions? Ms. Boyer, you have the floor.
Great, thank you. I appreciate it. Again, thank you for having me. It's a pleasure to keep updating as our portfolio develops here. So let me take a minute and share my screen. Okay. Okay, perfect. So I'm here today to present Q1 for the portfolio. I will start at the beginning. So as you all know, we started this program in May of 2017. So we are a little bit over 4 years into investing and deploying this program. The fund size for the strategic partnership is almost 275 million for the Federated plan. We've stayed very consistent in our plan, deploying capital in each vintage year over time. And you'll see here the performance and kind of general statistics of the fund. I would point out that the last year has been a great value driver for the portfolio, probably similar to other portfolios you've seen. When I compare these Q1 valuations and marks to Q4, we saw a great uptick. So when we showed this to you, the Q4 numbers, the net multiple for this NB partnership, which is shown in the middle column, was 1.4. It was in Q1 reported to be 1.6 times a net multiple and a 31.2% net IRR. One of the great items that have come through this year also, as your portfolio has developed and matured, we're now really starting to see more realizations within the fund. So you'll see here distributions of 2.3 million. A preview for the next quarter, you'll actually see that number jump by 10 million. So in Q2, we distributed an additional 10 million back to San Jose Federated. So that's great development. We continue to see realizations across the portfolio, and we'll of course keep you all up to date as that progresses. Typically, just in the market, we see Q4 to be the highest quarter for companies selling, acquiring, and completing transactions. So we expect to continue to see that number move up. This is obviously Q1 reported. We have actually released the Q2 financial statements already. And overall, the value of that portfolio will be up right at 16%. So in Q2, you'll see another great increase to the portfolio. I will move on to the next few pages, which I won't go into detail on each line item. The first page here shows what we call your legacy investments. So the investments that were made prior to the Neuberger strategic partnership, and that performance and how that relates to the peer group. So you'll see on the right, the quartiling metrics of each one of those funds. The next, let's see, 3 pages are the exact same analysis for Neuberger. You'll see here how each fund is performing on a gross basis, as well as the quartiling metrics for those funds. You'll see the vintage year in the middle, which is the year that that fund started investing. So you can kind of see the progression of that. We definitely have some new investments that are still actively deploying capital. So a lot of these return metrics will continue to change as investments are deployed and put into the ground. And then obviously as the operating and private equity firms continue to develop those companies and hopefully able to realize. So I'll point out here a little bit of the diversification within the portfolio. We show the Neuberger strategic partnership, as well as what that looks like on a combined basis for Neuberger and the legacy program. The committed capital shows exactly what we've committed to date, and invested, as a reminder, is the capital that's actually been called or deployed into investments. So over time, you'll see the primary bucket continue to move closer to the committed bucket. This is a very interesting page. You'll see here the performance of the portfolio on a couple different metrics. So at the top, you'll see the performance laid out by investment type, which is primary funds, secondary investments, and co-investments. Primary funds being an investment we make directly into a private equity fund. Secondaries is any type of secondary investment we're making on the secondary market, and a co-investment is directly into a company alongside a sponsor. So the interesting dynamic on this page is every investment type compared to last quarter, the performance moved up. The co-investments is where we saw a lot of what has been driving the returns. So in Q4 2020, the gross TVPI for co-investments was 1.44 times. And now you'll see it's 1.78 times. So that's been a really great driver within the portfolio. And at the bottom there, you'll see how this portfolio benchmarks against peers. So we have both the Q1 2021 and Q4 metrics, performance, net IRR, net TVPI, and the Q4 is then quartiled against peers. So you'll see on an IRR basis, second quartile with a 24.84% compared to the first quartile being 26, and then a first quartile metric for the net TVPI. I did want to mention, just because the co-investment performance has been great, we have seen a lot of uptick within that within some of those valuations. And I wanted to give you just an idea of what types of companies are in there. So we've made one investment within the last year that not only in Q1 saw an uptick in value, but we'll also see a larger uptick in value in Q2. It's a company that actually sells domains to end users. So if you see, .com, .edu, .news, all of those are domains that are bought and sold. And so this is a registry operator, and they were combining themselves or merging themselves with an operator or a service operator for those domains. We've seen that company since our ownership, which has been less than a year of ownership, organically grow quite a bit. And I would say even outside of the market has gone up, this company has just been performing very well. We were also able to buy into this company at very attractive multiples compared to other comparable companies within the market. They're trading anywhere from 28 to 30 times. We purchased it at a much lower entry price. And then combining those two companies, there were a lot of synergies combining those two companies. So there's kind of an immediate uptick in the EBITDA simply because those two companies are able to cut quite a bit of cost. So that's just a highlight example of a type of company that we've included in your portfolio that we think has a lot of potential. So I just wanted to highlight that. That's all I had planned to say. So if there's any questions, I'd be happy to answer any questions about the portfolio or any other items.
All right, thank you. Trustees, any questions? I did have a question myself.
Mm-hmm.
If we can go back to the first page of the NB partnerships, no, forward. Where we highlight the individual line items of investments. There we go.
Okay.
So the second one down, investment 54, 2017 vintage, 7.9 million.
Yep.
I'm looking at the report from a year ago, and it appears that that is titled investment 44. Can you explain how these are titled? I would like to be able to follow these investments from presentation to presentation.
Yeah, so the order that they're laid out on the page should be exactly the same to what you're seeing a year ago. It does look like the numbers have changed. So I can go back and make sure that our team is making sure they're the same number so that it's easier to track. But the order is exactly the same. We're putting them in order by our timing of investment. So, the very first investment we made is at the top of this page, and it continues to go down.
Right. Okay. I think I would appreciate consistency in labeling, because what's called investment 44 here is rather obviously not the same as investment 44 in reported March 31st, 2020.
Yes, so, understand. We can do that.
Thank you. And I appreciate your highlighting some of our successes in the co-investment space, but please feel free to tell us, where we've gone astray. So we shouldn't just hear the good news. We should hear the mistakes as well.
Yes, happy to do so. I mean, if I can take a minute to do that now, you highlighted the one that is not performing as we would expect, labeled investment 54 on today's presentation, second line item. This is a fund investment that we've made with a GP that we have a prior relationship with. Their prior fund is doing extremely well. This fund, they are taking a very long time to invest. So I would say it's a combination of they're being very conservative in looking at investments. They are in the retail space. So they typically look for companies that are, I wouldn't say distressed, but companies that are, you can take and do some operational work to achieve that return. And they've frankly just taken a very long time to invest. The first couple of years, they didn't make an investment. They made one investment. So it's been a much slower deployment path than we would have expected. So that's definitely one I would highlight.
Thank you. Any further follow-on questions from trustees? Any questions from the public? Hearing none, thank you, and let's move on to the next item.
Thank you, Mr. Chairman. I would like to invite Laura Wyrick and Jared Pratt of Nikita to talk about items 3, C, D, and E.
Good morning, everyone. It's nice to see you. My colleague Jared Pratt is going to discuss the private markets report.
Thank you, Laura. Good morning, everybody. So on the private markets report, also as of first quarter, just like the Neuberger Berman presentation. So here we have an overview of each of the sleeves of the private markets program. So if you just look at the far two right columns, you'll see your IRR compared to a public market equivalent. You can see as you look down the columns is that it is a favorable comparison in most cases. I'd also note that the 8% total IRR you see on the bottom is quite strong in an absolute sense and is a full percent better than was reported just a quarter ago. So that number was 7% at the end of fourth quarter, and now it's at 8%. If we go into some specifics of each sleeve of this here, so the private debt program, as I mentioned before, it's a decade old, so quite mature in the sense of it's actually overweight its target at 3.5% versus a 3% target. And it's also mature in the sense of not having much left as far as unfunded commitments go. You can see performance on the bottom right isn't as favorable as some other groups. And as we've mentioned before, that has a lot to do with some large 2010 vintage year commitments that didn't work out, commitments made by prior staff. If we go to page 4, you can see very sizable distributions here over the last quarter. Again, an indication of how mature the plan is. And if I go to page 6, you just see dollar return details of each individual strategy. There's quite a few line items here, as you'll note, but one in particular that's done extremely well is Arbor Lane 2 here in the middle with an IRR close to 30%. Moving on to real assets. These are up to about half the target weight, so 1.5% now against the 3% target. So still ramping up. You can see an IRR here at the bottom of close to 8%, and that's catching up to peers. So the prior quarter, it was trailing peers more, and now we've caught up a little bit, and at 8% is obviously pretty good. On page 9, you can see this program still ramping up. As I mentioned, you can see contributions to managers, outweighing distributions from managers by quite a bit. So this is still ramping up. And to look at the individual line items again, there have been several commitments in the last couple of years. You can see most of them have NM for not material performance yet, not meaningful. The track record's not long enough, but those will start showing up over time. And then if I look at real estate here on page 13, so this is basically near target, slightly overweight at 3.3 against a 3% target. And if I just skip ahead here to the individual line items, again, quite a few line items here, so I won't highlight anything in particular, except that on the very bottom row, that 6.2% IRR is edging out peers. So now I went through that quickly, but those are the high level points I wanted to make. The rest of the presentation just talks about various private market overviews from a 30,000 foot standpoint. So with that, I'll stop and see if anybody has any questions.
Thank you, Mr. Pratt. Are there any questions from trustees?
None here.
Any questions from the public? Okay, thank you. Let's move along to the next presentation.
Great, thank you. We have the quarterly review for the pension fund here. So I'd like to just start off by congratulating the trustees and the staff for a great fiscal year. The market value has gone up from 2.18 as of the end of the last fiscal year to 2.83. So not too far off from $1 billion in added value because there have been regular outflows during the year. I'll talk first about the market environment in the second quarter of 2021 on page 4. You can see that commodities were quite strong, a very volatile asset class that when we have supply shortages tends to perform well, followed by real estate investment trusts. And then you can see a quite strong environment in the second quarter of 2021 for US equities, with the S&P 500 and Russell 3000 indexes up over 8%. Global equities did well also, with the All Country World Index up over 7%, non-US equities up over 5%, and emerging markets up 5% for the second quarter. So it was a strong environment for risk assets. Really every major asset class was positive, including down to investment grade bonds up 1.8% for the quarter. Since the end of June through yesterday, quarter to date returns remain positive. US equities since June 30th have been up 2.6%. Non-US developed equities up 1.8%. However, emerging markets have been down 7.5% since the end of June. And your investment officer, Ms. Wang, talked about some of the reasons for that with China in her update earlier. Negative returns in China are really driving those negative emerging markets returns. Going to slide 5. Just to point out, we still have some quite strong one-year returns through the end of June, and that was really driving the strong performance that we've seen for your fund over the past year. You see certain asset classes, in particular, riskier asset classes like small cap in the United States up quite strong. Given that we are now sitting at the end of September, I think I'll skip the rest of the market commentary here through the end of June and get into your specific system. So if we take a look at page 24, you can see that total assets stood at 2.8 billion as of the end of June. The current allocations are quite close to the policy as intended. And then flipping to the next slide, you can see that the total fund return for the 1 year fell just short of 30%. So many multiples of your actuarial assumed rate of return. So 29.2% return for the 1 year period. And that outperformed all of the underlying benchmarks quite strongly. The policy benchmark, the investable benchmark portfolio, the low-cost passive portfolio, and a 60-40 blend. A 60-40 blend would have been up 24.5%, so a really strong absolute return, but your fund was up, much more than that. You see the peer median at 27%, again, also quite strong, but your fund 7 billion is now 2.8. You can see that there were net cash flows out of the fund of about 53 million and investment gains of almost 200 million just during that 3-month period. I'll talk just a little bit more about longer term metrics if we look at page 52 and 53. If we look in particular at 53 and just look at sort of it's not quite a full market cycle because it's been a pretty unique market environment, but if we look at a longer term 5-year period here, You can see for the 5-year period, the fund, because it was more conservatively positioned over that time, while it had a return of almost 10% per year, every year out of the last 5 years, that was a return that was somewhat behind the peer median. That's on the far left. But if you look at the risk of the fund, it was below the peer median. That's the second column. Risk for the fund of 7.7 versus a peer median of 8.7. That resulted in a Sharpe ratio that was strong at 1.1% and ranked above the median in the 38th percentile. So, you know, this is sort of what we like to see. And if we look at the 3-year period, we actually see that in the 3-year period, we had a fund return that was well above median and in the top quartile. We see a standard deviation that is still below median, which is a good thing in terms of volatility. And that has a Sharpe ratio then that ranks in the top quartile of the peer group. So we see improving metrics for the fund between the 5 and 3-year periods. So that wraps up my comments, high-level comments on the pension fund. Congratulations again to the board for adding so much value to the fund during the past year.
Okay, thank you very much. Are there any questions from the trustees or any other slides from the presentation they wish to review? Any questions from the public? Thank you again. Let's move to the next presentation.
Great, thank you. So the next presentation is the Healthcare Trust. As you know, the Healthcare Trust uses a similar strategy on asset allocation, but doesn't have the same level of illiquid assets or as many managers, given that the market value is lower. You can see here a market value of 382.6 million as of the end of June, and the current allocation, as we would expect, quite close to policy. You take a look at page 24. I know we've talked many times in the past about how this health and welfare fund is a bit more aggressively positioned than some others because it has an expected return relatively close to that of the pension fund. That is a good thing in up markets because you can see here the 1-year return is almost 25% ahead of the policy benchmark, and also more than 2 times higher than the peer median. So you can see that the 1-year return is in the top decile. The quarter return at 4.4% is also well ahead of the peer median for health and welfare funds and is in the top quartile. And you can see here this fund has a relatively simple asset allocation. I think it's also interesting to think about how, you know, the pension fund had a almost 30% return. This fund had an almost 25% return. You know, in some market environments, we've seen that more complexity and more private markets on the pension side, you know, wasn't advantageous, but it certainly has been recently in this past 1-year period with adding, you know, more value with the private markets and some of the other asset classes that we have in the pension fund. One area that this fund has that the pension does not is commodities. You can see on page 25, commodities have been in the fund since January of 2015. Over the long term, they haven't added a ton of value. You can see that they're up 0.8%, you know, significantly outperforming the index, which was negative during that time period. These are really here as sort of an inflation hedge or an extreme market stress hedge. You can see for the 1-year period, a return of almost 38% for commodities. So that was certainly additive to this fund. With that, I won't go into individual managers since they are similar to the pension, but I'm happy to answer any questions.
And thank you, trustees. Any questions? Any questions from the public? Okay, I'm not, by the way, Linda, I cannot see if any hands are raised on my screen, so please let me know if somebody has raised their hand. So with no questions, thank you, Laura, again, and we can move to the next presentation.
Thank you.
So we are up to new business, item 4A. And oral
Thank you.
update from our CEO, Roberto.
Thank you,
please.
Mr. Chair. Thank you. Welcome. Good morning, everyone. Just a couple of minutes, if you bear with me. I do want to remind you, as you know, right now you only have 5 of the 7 seats of your board that are filled, and you have 1 trustee absent this morning. The 2 seats that are open, the retiree seat and another active member seat, the staff is still working with the clerk office on this process. I plan on bringing you an update at the October meeting on how that process is ongoing. I think that we are much quicker to fill your active member seat than the retiree, but again, I will make a point for your October meeting to have a more detailed explanation on how the process is ongoing. I also wanted to share with you that the city actually pushed further out the return to the office on-site work. Initially, they had looked at October 1st for a deadline to bring back employees because of continuing issues, including the Delta variant. They pushed that date now to November 1st. Although the city does have some skeleton crews in some areas, just like we do in our office, that come to the office from time to time. For the most part, they're going to, the intent is to try to start bringing back employees, even if it's in a hybrid approach, which is what we are pretending to do in our office by November 1st. If the city remains with that deadline, our goal is to have a hybrid approach with staff and start having staff coming back to the office, but not everyone here 5 days a week. Again, that will be a hybrid approach, and is to make sure that we follow CDC suggested guidelines. I think Trustee Jennings mentioned this before. The city is now proceeding with stage 2 of the vaccination program. Stage 2 actually requires that every employee is vaccinated by September 30th, which is next at the end of the month, next Thursday, unless, of course, you file for either a religious or a medical exception, which you certainly can do that. But at this point, again, the requirement is that all employees are vaccinated by September 30th. Otherwise, you do have to file for an exception on a religious or the medical basis. I also wanted to share with you that November 1st to November 30th is our open enrollment for healthcare for retirees. We were wondering whether it was going to be an on-site program or virtual. We actually decided for the latter, so it's going to be just like we did last year. It's going to be a virtual program throughout the month with presentations from various providers and having staff available for questions. Again, the open enrollment for healthcare goes from November 1st to November 30th, and planning is already in progress. Also wanted to share with you and remind you, I think Prabhu mentioned this, we do have next Thursday the joint meeting of the boards with the city council on the POB discussion. The meeting, I believe is 1:30 to 4:30. It could be 1 to 4, but I believe it's 1:30 to 4:30 p.m. And there's a possibility that discussion, that meeting may not be enough. So there's a good chance that the city staff is going to be going to the city council in October to get approval for the validation process. And so there's a very good chance that later on, whether it's sometime later in this year or early 2022, we schedule a second joint meeting to address all the potential issues and some questions that may remain after our first meeting. But again, we will keep you posted if that is the case, and we certainly look forward to the presentation next week. Lastly, I wanted to give you some updates from personnel. We did welcome a new benefit analyst this week, Michelle. I'm not sure if I'm pronouncing the last name correctly, Chow. She started on Monday, September 20th, and she came to us from another department within the city. But by the same token, we are losing Peter Fan. Peter is in our IT group, and he is leaving us. His last day is October 1st. He started with a new department within the city on October 4th. And lastly, I wanted to let you know, we did receive the request for actuarial information from our actuary as they are working on the valuation process. And I just wanted to remind you that for the June 30th, 2021, which the schedule was included in your consent agenda, it's going to be a bit different this year because as we do every 5 years, the process by Chiron, our actuarial firm, is also going to include an audit of the evaluation process by the Seagull company. So you're going to receive presentations not only from Chiron as your actuary, but also from Seagull later in the year on the results of the audit of the evaluation process performed by Chiron. And that concludes my update, Mr. Chair. I'm happy to address or answer any questions.
Thank you, Roberto. Any questions from trustees? Quick question. I know I've seen a preliminary agenda for next week's joint meeting. Do we have a final agenda on that yet?
It is, and we will make it available this week for all trustees. I know the city is going to, they need to post that today, 7 days in advance. So as soon as it's available, we'll make it available to the boards, yes.
No, I do have a question.
Please go ahead, Vice Chair Jennings.
Okay. In regards to the replacement trustees, so you stated there might be a delay. Does that mean that the active, the employee, the city employee trustee might be hired or hired, be, I guess, accepted, drafted, yeah, whatever you want to call it.
Dragoon.
Before January, and that the retiree might be January or later? I just wanted to understand the time difference you were talking about.
I don't have a specific timelines, Trustee Jenny, but because of where they are in the processes for both seats, seems to me that the appointment of the active employee will be going to the city council sooner than the retiree appointment. My understanding is that there were some issues with the original retiree application process, meaning that there was some apparently mistakes that occurred in the process, and that the city clerk have to kick off that process again, which leads me to believe that at the earliest it will be late 2021 before the retiree could be going to the city council for appointment, if not early in 2022. In regards to the employee, my understanding is that they were towards the end part of that process, and so I haven't received any updates the last week or so, even though I did seek to request, I did request updates. We haven't heard back yet. And so I'm guessing that appointment will be coming before the city council later this year, if not in October, definitely by November.
That's the active employee.
And the active employee, that is correct, yes.
And so the retiree trustee is not in sync with the active employee, is that it?
No, they're being run concurrently, but they're not at the same page. Again, the active is a lot further advanced, so almost completed compared to the retiree one, yes.
And that's putting it out there, or the person has replied and going through? I mean, because I haven't seen an election. I haven't seen anything mailed.
The election, if I understand correctly, I think the council changed the requirements some time back. And so I think that there's an election when I believe, if there are, Linda, if I'm mistaken, correct me, if there are 3 candidates or more, they will perform an election, is that? Or is that for the retiree only, Linda, and not for the active?
That's for the retiree.
Okay, for the active, I think the challenge with the active, Trustee Jennings, is that we don't usually get members willing to apply, as you well know,
Yes.
for the board. And so I think there was only one applicant that,
Right.
that they were going to the process. So that's really what it is. There was only one applicant. I don't know where they are in the process of validating that one member, that they have the experience of the signatures that are required to be able to be accepted. So again, I did request an update and I haven't received one. So as soon as I get one, I'll let you know. But my understanding is that there might only be one active employee willingness to file. And
Right.
so that will not require going
Election.
to an election. And so it will make the process a lot
Interesting.
quicker. Yes.
Because I was the only one running and I still had to go through an election. So that changed after that.
Well, so that's a good point. Again, I need to follow up with the city clerk. I just don't see, right? If there's only one active employee, what election, I mean, that seems like a lot of waste of time and money. But again, I need to hear back from the city clerk. I haven't heard back on the specifics, although I do know, I remember that there was only one active employee's willingness to file for the position. And as I said, we have been having trouble finding employees that are willing to participate and join the board. So again, as soon as I hear from the city clerk on where we are in the process, I can provide the update.
Okay.
Okay, Roberto, as a future agenda item, either for the full board or perhaps the governance committee, do we need to take up the attractiveness of trustee service and what incentives can be changed within the scope of law?
Well, that's really under the purview of the city council. They are the one that actually establish the rules of well, first there's the code requirements by the law, but then there are the specific requirements by the governance of the city council, which they actually went through a governance process some 10 years ago, and that's what changed not only the composition of the boards, but also the experience requirements for the public members. So again, that's under the purview of the city council. I think they done as much as at least they wanted to do at that point. Before you join us, Trustee Horowitz, both boards provided staff with input on how to try to make these positions encourage members from the public and members from the plans to apply. And we have implemented those, meaning if they're public members, we reach out to different agencies outside the city, including healthcare and financial and other areas and universities. And from the public, we reach out to the unions. I'm sorry, for the plan members, we do reach out to the unions and let them know. Linda actually leads that, spearhead that process. Linda, can you comment a little more on the reach out that we do for the boards?
Yes, Roberto, you covered it. We reach out to the municipalities, the universities, the state colleges, the alumni associations, like Roberto said, the healthcare, like Santa Clara Family Health. Yes, you covered it, Roberto.
Well, and
the unions.
I can, as a city employee and trying to get someone on there, and I've been with the city for quite some time, 19 years, and I know a good amount of people and also people I've promoted. So I've reached out to a number of people who have worked for me or know me or whatever to try to offer them the ability who I think would be good members. And the problem that I see is that these people are very busy in their jobs. And don't have the additional time to take for the commitment, the time commitment. And that, I think, is their biggest concern, is that dual. A number of them are like managers, and given the complexity of their jobs and given the vacancy rate that the city is running, and the additional job duties, like, look at what Barbara does, or look at some of the other people that, they are probably extremely busy. So taking that additional job on is really the hardest thing. And sometimes, again, they're family people, they have children, whatever, I mean, they just don't have that bandwidth. And there's no financial incentive. I don't know if that's really necessary, but I do know that I had employees that would do language translations. They would get paid for that. There's no pay incentive to be a board member. Again, I don't know if that would make a difference. It didn't to me, but
Well, it sounds
just the
like
difficulty.
we're doing what we can within the scope of the law, and any further changes would be an action item for city council, if I understand correctly.
I think so. Yeah.
Okay, any further questions of the CEO? Thank you, Roberto. Let's move on to the next agenda item.
I don't have an update today. We're looking forward to the joint meeting next week.
Okay, great. And I believe the next agenda item is from Chiron. And before we get into the excitement of actuarial and amortization policy, let us take our 5-minute break. And I have it 10:05, and let us resume at 10:10. Let us proceed. Mr. Holowach.
Good morning, everyone.
Good morning.
Let me share my screen here. Hopefully everyone can see the screen.
Yes.
So in preparation for the pension obligation workshop and the process for the valuation, we wanted to take some time to do primarily an educational presentation on how we develop the amortization policy and how it might be affected by a pension obligation bond. And so to start out with, I wanted to just talk about the roles as we see it between the city and the retirement board on these issues. Obviously, the city sets the benefit policy. The retirement board has really no role in determining what benefits are to be provided. The city also has to pay the contributions. They pay the actuarially determined contribution that's set by the board, and then they have the option to pay a supplemental contribution. And so that's where the pension obligation bonds come in, is in the context of a supplemental contribution. The board is responsible for the investment policy of all of the assets and the policies that set the actuarially determined contribution. And that includes the assumptions, methods, and in particular, the amortization policy that we want to focus on today. We're going to start with some background. I'm going to have Jackie and Stephen go through some of the components of how we develop an amortization policy, and then we'll come back and look at your specific case and how that impacts POBs. So I'm going to turn it to Jackie to start with.
Good morning, everyone.
Good morning.
One of the first steps that we do in the valuation is one of the main steps is we calculate the projected benefit payments. So what we do is we take the plan provisions, we take the actuarial assumptions that we have determined that the board has elected to use, and we take the data for the current participants of the plan, and we calculate the projected benefit payment stream for those participants. So one thing to remember with this, the projected benefit payments, is that they're based on current members. We don't factor in any future entrants into the plan. It does factor in future accruals for current active participants, but just no new actives into the plan. Even though it's based on the actuarial assumptions, it's mostly based on the demographic assumptions of the plan. One assumption that does not affect this actual projected benefit payment stream is your discount rate or your expected return on assets, which is 6.625% right now. So just bear that in mind, in that that assumption does not affect these actual projected benefit payments. Okay, so what we do then is where that assumption, your discount rate and your expected rate of return comes into play, is you discount all those projected benefit payments. So what you can see is the bottom portion of the graph, which is the dark purple, that's the actual discounted value. And the light purple, that's the amount that's attributable to the interest on those benefit payments. So if you discount all of them, you can see that if you had, well, you can't really see from this, but if you had a higher interest rate, your interest portion would be much higher, and your projected benefit payments, that discounted value would be lower, and vice versa, according to that. So what we're going to focus on is that those dark purple bars at the bottom, that's the amount that that's the value as of today you would need to fund all the projected benefit payments for the current participants in the plan
if the plan were to earn the assumed return of 6.625%. What we're going to focus on is we're going to focus on that dark purple part of it. And that's a value as of your valuation date of those benefit payments. If you take the sum of all of those, you get what's called the present value of future benefits. Now what you do is the present value of future benefits can be broken down into two other portions. In your blue portion, you have your actuarial liability, which is the portion of the present value of future benefits that's attributable to benefits that have already been earned for your current participants. And then you have your present value of future normal costs, which is the portion of that liability that's attributable to benefits that your current active employees are going to earn in the future based on their future service in the plan. Once again, now, if we take away, we're going to focus on that portion that's attributable to the past service, which is your actuarial liability, which is really what your funding target for the plan is. That's what you're shooting to get to. So you can break that down a little bit further in that that's a liability that you want to get to. Well, you have the portion of your actuarial value of assets. That's the amount that's already in the fund, and that's your green portion there. And then you have what's called the unfunded actuarial liability, which this is the portion, this is the difference between the assets that you currently have and that funding target or actuarial liability. So that unfunded actuarial liability is what we really focus on when we start developing the amortization policy. So at this point, are there any questions?
Yes.
Sure.
Okay, Trustee Jennings. All right, so I'm sorry, but some of this is really confusing to me. And if you go back to your actuarial liability and the present value of future normal costs, I didn't quite take that leap between the present value of future benefits and then to that slide, the gray part. I don't quite get that one.
So your present value of future benefits, if you're looking at all your current participants in the plan, you're looking at the benefits that are going to be due to them in the future. And that's your present value of future benefits. Well, for your active participants in the plan, there's two parts to that projected benefit payment. There's the amount that they've already accrued. So if they were to leave the plan right now, what would their benefit be? And then there's a portion of what are they going to accrue from this valuation date through the time when they terminate or retire from the plan. So that present value of future normal costs is attributable to service that they haven't yet accrued, but they are expected to accrue.
Okay, so this is for employees that have not yet retired?
Yes, that are still active employees.
Or deferred?
No, not deferred. They're still active employees because deferred participants are not expected to accrue any more benefit. So they do not have any future service that's expected for them. So that present value future normal cost is really attributable to current active participants that are still accruing a service in the plan.
Okay, so they're still active employees. They're not retirees. And so we're doing this. Are we doing this analysis solely just for the active employees?
No, it's for everyone. So that blue portion, that actuarial liability, the portion that's attributable to past service, that includes your retirees, your deferred vesteds, and it includes a portion for your active participants, the amount that they've already accrued in the benefits that they've already accrued.
Okay, so the gray part is then for the active employees, like myself, I am an employee, right? So depending when I retire, you're trying to estimate when that might be, and possibly any increase in salary costs or something because of that as well?
Absolutely, yes.
All right. All right, so that takes you, so that's what you're doing there.
Yes.
And then
so the key here is it's based on service up to the valuation date. So any benefit that's attributable to service prior to the valuation date goes in the blue portion. Benefit attributable to service after the valuation date goes in the gray portion.
And the valuation date is the date you're doing this, or?
Yeah, so we're working on the June 30th, 2021 valuation. And so we'll do a measure as of June 30th, 2021. And we'll have an actuarial liability, and that will be for benefits attributable to service prior to June 30th, 2021. And then there will be a present value of future normal costs, which is attributable to benefits expected to be earned after June 30th, 2021.
Okay.
So for an active number, you'll have a piece in both.
Right. And then you go to the one that's the Christmas colors, the red and green, unfunded actuarial liability and the actuarial value of assets. Can you explain again to me what that is?
So basically the sum of these is that total actuarial liability, that blue bar that we were just talking about.
Oh, okay.
So that's the liability that you're trying to fund, where you can take out the portion that you've already funded, which is your current actuarial value of assets.
Okay.
And then the remaining portion is what still needs to be funded, which is referred to as the unfunded.
Or what someone like me has already put in, and that the city's already put in because I'm vested. And that's the blue box. Now we're taking that blue box and comparing it to what we actually have funded.
Correct.
And so the green.
The blue box is what we think you should have in terms of assets.
Okay. Yeah, it's what's the liability.
It's our funding target. It's the amount of assets that we think you should have as of today.
Okay. And then you're comparing it to what we actually have, and thus the green is what we actually have, and the red is what we don't have.
Correct.
Okay. All right. I understand. It's just you go through it really fast, and when, I mean, I'll just be honest. I have probably maybe, I'm being generous, 60-40 understanding of what you guys do. And 60 is what I understand and 40 is what I don't. So, but I think it's really important for me to understand this because we're going into the pension obligation and you're really trying to get us to a certain level. So thus I'm being a little more particular about what I don't understand.
Yeah, no, this is perfect. We want you to ask these questions. And I forgot to say at the beginning, feel free to interrupt as we're going along so you don't get lost on a slide.
And then you give up, you know, because you're lost.
Go too fast. Right.
Okay. All right. Thank you. I appreciate it.
Okay, so with that, I'm actually going to hand it over to Stephen because he's going to talk about how you actually get to funding that unfunded actuarial liability portion.
Okay, good morning, everyone. So as Jackie discussed, the total funding target, we split into an amount that's funded and an amount that's unfunded. So you can think of the total funding target as the assets that the trust would need today to pay all those benefits that Jackie showed in an earlier slide. So the shortfall is the unfunded actuarial liability. And as we show here, it's roughly $2 billion. Now there's a trade-off. How do you fund this, right? There's a trade-off between the length of time and the affordability. So, you know, paying it all in one go, $2 billion, it's probably not going to be affordable, but that would be a quick fix, right? On the other side, if you set too long of a period to pay this off, then you won't pay it off. You know, too long a period, and excuse me, you don't pay the interest. So there's a balance there, trying to set up an amortization period that is a reasonable period of time and that will also pay off the unfunded liability. So here we show one approach would be to pay this off over 20 years. So you can think of this as very similar to a 20-year mortgage payment, right? But the interest rate is the 6.625%. So that's you can think of it as the earnings on the assets that aren't there. And so similar to a mortgage payment, there is interest and principal being paid. So we show in the darker pink color the principal payments, and in the lighter color the expected investment earnings. So essentially the interest on those payments. So this is what a 20-year level payment would look like. Now that's straightforward. It's not how things are usually done. So here we show payments increasing at a rate of 2.75%. So that is the rate that is used for the Federated plan. And that is a rate of increase that's somewhere between inflation, the inflation assumption, and the payroll growth assumption. And the reason most plans do this is it better tracks payroll growth and revenue growth. So here, the level dollar payment sort of front loads things. So here we're showing what is currently done with the Federated plan, a rate of growth of 2.75% on these payments. And that amortization would pay off the $2 billion over 20 years with that rate of increase in there. So you can see it starts at 140, goes up to 240 million. Now, that's all fine and well, but the unfunded actuarial liability is not, it's a moving target. So it changes over time. And when it changes, we need to add, we need to tweak these payments so that the funding target will still be met out in the future. So here we're illustrating an experience loss, right? So gains and losses are currently for tier 1 amortized over 20 years. And so here you can see there's a new layer at the bottom, yellow. And so this would be if there was an experience loss, right, in the upcoming valuation, that gets amortized over those 20 years, it creates a new layer on the bottom there. Similarly, there could be experienced gains, right? So, good asset returns. If people, aren't living as long as expected, those sorts of things create experienced gains. So those actually create negative layers that decrease the amortization payments. So here we're showing how that works. Now, there are additionally other items that can change, right? As we do experience studies periodically, 5 years or so, some of the assumptions can change, and those impact the unfunded actuarial liability. And currently, those are funded over 25 years, so they're spread out a little bit longer to make them, I guess, for a little more stability. But we're illustrating a layer here in purple that shows an assumption change that is a positive of 4 million a year. So that would be an assumption change that increases liability.
So I think the thing to keep in mind here is that any valuation, the present value of all of these amortization payments has to add up to our unfunded liability. So when the unfunded liability changes, then we add another series of payments so that the total still adds up to the unfunded liability, payments or credits. And when you keep doing that year after year, you end up with this mosaic of amortization payments. Now, these are the amortization schedule from the 2020 valuation with the addition of the 2021 investment gain based credit that we've added on here. But you can see we reset the amortizations in 2009. So there's this huge payment layer from the unfunded liability in 2009, just like we kind of started in the example with the current 2 billion. And then since then, all the yellow boxes are different experience gains and losses. And all the purple are assumption changes that we've adopted in between. And so then this teal line shows the net scheduled amortization payment going out. And so you can see it's pretty stable, increasing at that 2.75%. And then when we get to the end of one that gets paid off, you'll see some kinks in the line as those things get paid off. And the big adjustment, of course, is when we pay off the 2009 piece, there would be a significant drop in the amortization payment. Now, we have a big investment gain this year, but we only recognize 20% of it each year. So we're smoothing that in the actuarial value of assets. So this is just that 20% piece. When we run our projections, we're projecting the rest of that gain to come in. And so we'll get the credit for the 2022 investment gain, 2023 investment gain. Now, these are all assuming that these future ones are all assuming that we earn 6 5/8% each year and all other assumptions match. But our baseline projections have these built in. And so all of a sudden we're creating a pretty significant set of amortization credits going forward.
What's the credit for 2022? I don't know. Is that like if there was one or?
No, what we're saying is it's actually the 2021 investment gain, but we're recognizing it over 5 years. So this is the credit in 2022 that would come from that investment gain if we continue to earn 6 5/8.
So in the prior slide, it was a credit for 2021 investment gain.
Right, which is, so it's primarily due to the market returns in 2021.
Yeah.
But we only recognize 20% of it.
Right, over 5 years?
Over each of the next 5 years. So this is the first installment. This is the second installment.
And it goes for 5 years.
Third installment.
I see. Okay, gotcha. And then it falls off.
Yeah, and then that's it.
Okay.
And so if you look at what that does to our net amortization payment, it drops it from the teal line down to the dark blue line. And so that's a reduction in amortization payments of about $40 million once it's fully recognized per year.
Yeah.
The other thing that that actually does is out here in the future, it creates a net amortization credit. So we've got a net amortization credit of over $40 million scheduled in 2042. Now that's a long ways out. That assumes we get 6 5/8% return for the next 20 years. So I certainly wouldn't bank on that credit yet. But that's what we'd have scheduled there. Now, there's an interesting little dynamic here. We have a minimum contribution in the plan equal to the normal cost. And so the only credit, the maximum credit we can take is just to pay our administrative expenses. And so the rest of this credit, so that'd be, we're estimating about 4 million that we could take in 2041 out of the $41 million credit. The rest of that credit just rolls over and maintains or helps build a surplus. So if we get there, that would be the dynamic. But that may come into play when you're designing a pension obligation bond now. And so we'll come back to that.
So the big nut is the 2009.
Yes. That's the big piece. Yeah, there's all these little pieces, and there will be new pieces that come in here during this period that we're not showing because we're just assuming all of our assumptions are met.
So what would happen if the city paid off that 2009 UAL?
Well, so we'll technically the city can't directly pay off the 2009 UAL, but we'll show how that could effectively work, and you would just eliminate those payments effectively.
Because that's, if you look at that, what is that about?
So the current payment is about 59 million.
59, it's about 60 million.
And it, but it grows up here to 94 million.
But if you hit it in 2022 with 60 million, so if you put a inflow.
No, that's the annual payment. You'd have to pay more to pay it all off. So let me get to that and what happens with the POB here. So this is the same picture we're just starting with the net amortization and saying, okay, what happens if we get a 20-year, $250 million POB deposited? And so really from the plan perspective, we're just looking at a deposit of $250 million. Under our current policies, we would just create an amortization credit here, this green area, over 20 years that increases at 2.75%. And so that would move the net payment that we would charge the city from the blue line down to the dark green line.
I see.
And so then there is this issue here out at 20 years where it's increasing the amortization credits that can't be used. And so there's limited benefit there, but that's out 20 years or 18 years. Now, from the city's perspective, though, they have to pay a debt service on the pension obligation bond. And so while it wouldn't be in our amortization schedule, I added a piece here for their debt service. And we understand that they intend to set it up as a level dollar payment. And I set it for 20 years, assuming 3% interest on the POB, just as an illustration. And so then this lighter green line shows the net payment to the plan plus the city's debt service on the POB. And so you can see in the early years, it starts out fairly close because we set up our amortization credit with a 2.75% increase each year, and they set up their debt service as a flat dollar amount. But theirs is based on 3% and ours is based on 6 5/8. Those happen to work out to be pretty close to the same number at the beginning. But over time, as the amortization credit increases and the POB debt service does not, the difference grows. Now, when we get to the full funding position here, the payment to the plan is capped by the same minimum, but then the city has to pay their debt service on top of that. So the actual payments for the city would be higher in those years with the POB.
Bill, looking at this, first of all, if we look at 2036, my eyesight is strained. What's the actual delta between the current amortization projection versus what the net would be with the POB? So that's 146 versus 155. So under $10 million delta.
Yes.
And then, of course, over the course of time, one has to equalize the positive effect with the negative effect out in years 2040 and beyond. Is there even a positive a total amount to the city plus pension plan? Equalizing the amounts above the line and amounts below the line?
I haven't done that calculation because I suspect, given this dynamic, what the city would actually look to do is something more like a 17-year bond. And while the board's policy would be to stretch the amortization credit over 20 years if we didn't make any change, we would recommend that the board match the amortization credit period with the term of the bond. So if they did a 17-year bond, we would recommend that you shorten the 20 to 17 years to match up with their bond period. And so if they do that, then it takes out that issue of the expected full funding. Now, one thing to keep in mind here is this is 20 years out, so it's very uncertain about what is going to happen. But if you're doing a pension obligation bond, you're betting on good investment returns, not bad investment returns.
Right.
And so
the uncertainty is in the returns. It'll be quite certain what the pension obligation bond payments will be.
Right. Yes. These payments will be set once we will set up this amortization credit, which the actual credit each year could be affected by our amortization policy, including our discount rate. So that might change. But in addition, the assets we get are going to contribute to any investment gain or loss that we have. And so these future gold bars, whether they're positive or negative, will be larger in magnitude because we have additional assets from the
Thank
field.
you.
Bill, isn't it, you had said, you know, doing a pension obligation bond, you're betting on good investment returns, not bad investment returns. Wouldn't it be truer to say you're betting on near-term good investment returns as opposed to just in general? Because it's more important that they happen. It's more important that they happen early in the term as opposed to later.
Yes, absolutely correct. It's more important that they happen early. It's also, when we say good, it's really investment returns greater than the interest rate on the bonds rather than greater than our assumed rate of return. So there's a little bit of a difference in there as well.
Thank you for that distinction. Appreciate that.
But that's the dynamic that you would see on this. And so just looking, I don't know what the city is really considering doing, but I would expect they'd be, for your plan, they'd be looking at something like this 17-year bond, just because of the schedule that we've set up here. Now, we do have complete control over this schedule, and we can make changes to it. And in fact, for police and fire, we have, We have not done it for Federated other than minor tweaks to the schedule. But normally we are looking for pretty stable future contributions. And so I wouldn't be surprised if when we get out 10 more years, if we're still looking at this cliff, dropping contributions all at once, if we didn't want to consider some adjustment to have it gradually go down instead of just dropping off a cliff. Because to facilitate the city's budgeting, we prefer smoother changes to the contribution levels rather than either dropping off a cliff or scaling a cliff. That creates more disruption. And we did do that for police and fire. Their cliff was coming much earlier because they had a 15-year amortization schedule. And when we put this 2009 base in, it was over 30 years, which is why it ends in 2039. And so their cliff was much earlier. And so we did make some changes to it so that it's a smoother downslope rather than dropping off a cliff. I have some conclusions here. I think the important thing is that the board will need to decide how to establish those amortization credits for any POB. We will be recommending that the period of the credits match the period of the POB, and also that we make sure that the initial credit in the first year is at least as large as the city's initial debt service, so that at the time the city makes the contribution, their combined payment to the plan and to the POB does not go up. It may go down, but we would structure it so that it does not go up. But after that, it's going to depend on what the experience of the plan is. We'd have a schedule that would continue that, but the experience of the plan would adjust it as we go forward. So any questions on that? I wanted to switch over to our model and just show you some sensitivity to investment returns and also to the discount rate. But before I leave this presentation, I wanted to check if there are any questions. Okay. I think I need to stop sharing and share a different screen. So hold on here just a brief minute. So this is our normal model we show with the valuation. I've added this actual cash flow. Yes means we're actually using the 2021 asset statements. So we've overridden our projections for 2021 with the actual contributions, actual benefit payments, and actual investment earnings during the period. So the top graph shows the projection of the liability. The green line shows the market value of assets. The blue line, the smooth actuarial value of assets. And at the top, we're showing the funded ratio based on the market value of assets. So we're projecting that it's increased from 50% to 64% as of 2021. The bottom, we're showing the contributions as a percent of pay. The member in purple and the city in gold. The black line is that normal cost. It's the value of the benefits attributed to that current year of service That is also the minimum contribution level. All the payments above that black line are going to pay off the unfunded liability. So you can see the vast majority of the city's payment right now is going directly to pay the unfunded liability. The red line shows what our projection was in the last valuation. So the difference between the red line and the gold bars is just the impact of the investment returns this year, in this last year.
Can you say that again?
The difference between the red line and the top of the gold bars is the impact of the investment returns we earned in 2021, the 30% return.
So it's gone down. The gold bar's gone down.
So the gold bars have gone down. It's driven the contribution down significantly. We're looking at it as a percentage of pay here. The pattern here is something that we like to see, both in that it's going down, but it moves relatively smoothly until you get out to 2040.
So that's been a benefit to the city because their contribution on retirement's gone down.
Yes.
Right.
Now, that's because we got the 30% returns. So, these projections are not set in stone, but let me change the baseline red line so that it matches that projection. And then I'm just going to put in a couple different returns here to show you what could happen going forward. So if we got a 0 return, we're going to see a gradual increase over those projections, but it's not dramatic and does not get us all the way back to where we were. We put in something more drastic, like a minus 15%, puts us back much closer to where we were before. And you can see it causes our funded ratio to drop back to 53. So there's still, there's still a risk of going back to where we were. But that's a pretty significant negative return in 1 year.
Bill.
Yes.
If I may, a couple of things. When you refer to the funding ratio on the top, that funding ratio is on a market value basis, not on the actuarial value basis, right? Which of course the city makes contributions on the actuarial value basis, not on the market value basis, right?
Right, which is why you see the contribution amounts don't bounce around as dramatically as that funded ratio does.
That's correct. And then the other thing I was going to say, which I mention every time, I have mentioned this before, I do it in the police and fire, Federated, the original tables or graphs that you show, again, just like on the left-hand side, except for the 15% negative for 2022, it indicates a 6 and 5A assumed rate of return matching the assumption. So all the numbers here assume that we're going to be meeting all the assumptions right on target, which is we know is not the case. The other thing I wanted to say is I want to thank you. I know you plan to bring this model to the stress testing, to the joint meeting of the boards with the city council as well, so that everyone can see what would happen if we have better results than expected, results just as we expected them to be, or results that are more negative than we expecting, so that they can see how the funding ratio and contributions will move around. Does that make sense?
Yes.
Okay.
We are putting together just some illustrative scenarios to show the city council, so we don't have to just freelance, but then we will have the ability to freelance if they so choose.
Of course, we can ask Prabhu if he can return us 20% every year for the next few years, and then we should be all set. But I'm not sure Prabhu is.
Yeah, if we can get a repeat performance, it would drive us up above 80% funded on a market value basis.
I see.
Bill,
that's
can
a
I
really
make a
good thing.
suggestion?
Mm-hmm.
On the illustrations that you're going to do at the joint meeting. So the 6.625 assumed rate of return is something that in the time that I've been on this board now, almost 5 years, the assumed rate of return has gone down at least 1/8 of a point, if not more, every year or two. So what I would be, and I don't know if there's a floor there hasn't been a floor that's been discussed, but the risk-free return that we've been talking about is much, much lower than the 6.625 that we are targeted at our assumed rate of return. So it would be helpful for me, I think, if you did not assume a discount rate of 6.625% for these projections, since you're doing an illustration for us, but rather decreasing by at least 1/8 every year, so that we could actually see what is most likely to happen, as opposed to this assumption that we all know is not true. And we're not even in 20 years likely, going by 1/8, if I'm doing my math correctly, we're not going to get to the floor of a risk-free set of assets. So that would be a helpful thing for me to see in this illustration.
So I don't think there's a plan to get to a risk-free rate.
I don't think there is either, but
what we've had is changing market conditions. So interest rates have gone down and the capital market assumptions have changed. And that's been driving, lower and lower assumed rates of return across the board, not just with your plan. I'm happy to show, some projections at different discount rates. But I don't think I would want to represent that 1/8% reduction in discount rate per year over the next 10 or 20 years is the most likely path.
So if we have a better funded plan, my read on this board's discussions over the last 5 years would be that decreasing risk, de-risking the plan would be advantageous. Part of the reason that the assumed rate of return continues to go down is part of the issue about taking too much risk. So I beg to differ with your assessment.
So I did want to show here some impacts of changing the discount rate. And I wanted to start by changing the graph up here so it's a little easier to see. This is the unfunded liability that we're graphing here. So it was about 2.2 billion. It's now projected to be 1.6 billion in 2021. And so if we did drop the discount rate, let's say we dropped it all the way to 6 1/4, we would estimate that would increase the unfunded liability to 1.85%. And then you can see how it would affect the contributions going forward.
Yeah, I think that would make sense. I mean, as a board, we're not going to change the discount rate on an annual basis. I mean, it's a big decision to make that change. However, if it wasn't for the great results that we had, right, and that was kind of individual because the market tanked, it was an opportunity, and we were positioned to be able to utilize that opportunity, but notwithstanding that might keep on being the story going forward. 6.25 might be the path we would go to lower things. And, then maybe 5 years from now, we might change it again or something like that. But I don't see us changing it on an annual basis. I just don't see that going. And all the meetings or educational things I've done, I don't see other retirement systems doing that. I mean, it takes a while before they change the discount rate, right?
Julie, it has changed 3 times in the 5 years I have been on this board. It changes every other year.
We have lowered it
Yes.
over
We
every
have
other
done
year.
part of our mandate, right, as the board members, is to review the strategic asset allocation, and over the course of that conversation with Chiron and the external consultants and amongst the IC, is that conversation around what the discount rate ought to be. And it's driven by a bunch of factors. I think it might be just a little bit off agenda from maybe what Bill is trying to share with us at the moment. What is the perfect discount rate? And I don't think there's a right answer. The question is, I'm thinking along what Councilwoman Davis was saying, is how best to present this chart to the broader group, sort of with the right caveats of, there's a lot of data there. So sort of starting with the basic definitions, where we are in discount rate currently, acknowledging that that number could change. I don't have any sense whether that's going to be 1/8 or 0.5% or 1%. Sorry about that, going forward. But I think we want to really sort of keep people focused on, sort of the key elements around that. Large unfunded actuarial liability is always going to be the elephant in the room. So I hope that's helpful.
I just think it's disingenuous to show this slide, for example, with a discount rate that decreases in 1 year and then stays the same. That has not been my experience historically.
I see.
And so my point is to make this change, if you're going to show a change, don't show an one big change
that it's fixed
1 year, but
see.
rather what we have seen over time, which is about 1/8 to 1/4% change, decrease. It has never increased in the time that I've been, and I believe that to be true from at least 15 years or more, that it decreases, regularly over time by 1/8 to 3/8%. So that needs to be, I think, added into this model, since this is a dynamic model, to say, if we're taking recent history as I think we should, being likely future events, then that needs to be shown in this model.
That's one of those cardinal laws that we're not allowed to do, is using most recent performance as indicative of future. So that's a difficult thing.
Well, I wasn't asking for performance. I was asking for behavior.
For behavior, just intellect, just a way of presenting it. I mean, I don't have a particular bias as to how it's presented, because either way, it's going to be, showing multiple scenarios. You can tweak any one of these different inputs to get to an outcome.
If I can suggest, Bill, I mean, the beauty of this particular slide is you've built the machine so we can do sensitivity analysis, and perhaps as illustrating what may be potentially be a worst case example, showing what 1/8 of a point decline in the discount rate annually going out to 2040, what that might look like. I mean, that's one possible future we don't know. My own view on the recent past is our pension plan, along with all the pension plans in the country, started out with discount rates maybe a decade ago, 8.5%, that were unrealistic, and they were constantly feeling for the floor. And we may be getting close to where the floor is. So I don't know that it's an iron rule that we will continue to decline the discount rate in future. It is a discussion we have every year, so it's a possibility that we change it annually. But I think the ideal is to get to a point where we come to a discount rate which we actually truly believe is reflective of a 20-year return that we can expect based on our asset allocation. And I don't think we will ever get to a risk-free allocation because, well, honestly, that wouldn't make much sense. We want to take some risk in the market in order to earn returns above the risk-free rate. So I think it could be illustrative to show that kind of decline, but the past may not necessarily be indicative of the future. So I think with all those caveats, I would hope we can have a discussion about this when we come to the joint meeting.
So one of the simple charts that I've shown, not just to you, but when I speak to audiences across the country about what's happened with public pension plans in general, is just showing the yield on the 10-year treasury compared to the median assumed rate of return for public plans. And back around 2000, the yield on the 10-year treasury was about 6%, 5 or 6%. And we were assuming 8. And now the yield on a 10-year treasury is about 1.5. And so that drop in interest rates has put extreme pressure on plans to either reduce their expected return or change their asset allocation because they have to beat a 10-year treasury by substantially more than they used to. And I think that's been the primary driver of reductions in discount rates in public plans over the last 20 years. What do we expect going forward? Well, there are two questions. One, what's going to happen in the markets to interest rates and valuations? But then also, do we want to narrow that gap between our expected return and the 10-year treasury? If we want to get it back to a 2 or 3% gap, that's going to mean that yes, we do have to have significant reductions in the discount rate going forward unless interest rates bounce back up. If we're comfortable with the gap we have now, then there's no change going forward. And so, projecting where we go with that, it is a matter of the risk assessment and what you want to do. I do think that equation, especially with the risk assessment, changes substantially if you become fully funded. But that's not in the near-term horizon for this plan. So that particular piece may come up in the future, or if we get some good returns, that could change our perspective on it sooner rather than later. But we're still looking a ways down the road before that becomes an issue. The other thing is this plan and other plans have tended to gradually reduce discount rates, even when the market moved more substantially, just because of the impact it has on the sponsor budgets. And so you may be reducing the discount rate an eighth or a quarter each year or two in an effort to get down to a more comfortable discount rate. But I think we're now, at least for this plan, within that range. Maybe there's a little more to go down or maybe not, depending on your perspective. We'll be presenting the updated capital market assumptions in October. So next month for this board to start looking at that.
Are there any other questions or comments from trustees? This is one of the most crucial questions that we grapple with. What are the expected future returns to an asset allocation that we might make? It is a complex issue and might be beyond the scope of this particular agenda item, but is one we will grapple with as Bill mentions when we deal with asset allocations and the capital market assumptions that we will hear next month. And if there are no further questions, comments, any public comment? We should then move to the next agenda item.
All right, thank you.
Thank you. Presentation by Fiduciary Council.
I guess that's me.
Tis.
Thank you. This is, I thought that was a terrific discussion following the slide presentation that will be featured, I think, in future conversations. So let's try to put a marker on that discussion with the board regarding the idea of de-risking the plan as we get closer to a full funding of the plan. That is a very intriguing and positive, powerful concept that most public plans haven't had the privilege of grappling with over the last several years. So I think it's something for the board to address. And what that tells me as your fiduciary counsel is the message that I really wanted to get across in a few minutes today in the discussion about the POBs. And that is to put this all in a bit of a context of what your responsibilities are as fiduciaries. I've given you a confidential legal memorandum. Maytak and I authored that for you to try to give you the context of how all this fits in with your fiduciary responsibilities. But you're very familiar with those responsibilities already, because in the ordinary course of what you do as trustees and stewards of this plan, amortization, which was the last presentation that Bill and Chiron presented to you, Jackie and Steve, the amortization discussion is really a piece of a much broader use of actuarial talent to assume certain things about the future in terms of job growth and hiring and mortality rates and the assumed rate of return. Those are things that this board deals with in the ordinary course on a regular basis as you go through the actuarial evaluation and you go through the asset allocation analysis and your risk benefit comfort levels, all those things that you do in the ordinary course. And as counsel in this process, my advice going forward in considering if they are to be eventual proceeds from a pension obligation bond that the city may find advantageous to issue, is to not disrupt our ordinary processes as a result of the influx of however many millions of dollars that may be of additional money from whatever source. I mean, the city could put additional contributions into the system either through a pension obligation bond or through additional funds coming from federal programs or general fund surplus. It's really, from the pension board point of view, we're agnostic about the source of that. And I'm going to revisit that because whether the city and its bond underwriters and the credit rating agencies believe that the arbitrage that's available to the city now to be able to borrow at 3% or less and put it into a plan that is growing at greater than that amount. Those are decisions that are not our board's decision. We don't care where the money comes from. We don't care what the cost it is to the city. We don't care what risk benefit analysis city has made. We're going to take the money in and we're going to plug it into our ordinary processes of asset allocation and investing in the markets. Let me mention, we had a presentation, I think Laura Wyrick from Makita highlighted today that in this last fiscal year, we took in over $700 million. And we did that and we treated it in the ordinary course of our asset liability studies and our asset allocation, our assumed rate of return. We didn't move the needle on those decisions because we took in $700 million. However much the pension obligation bonds may be, that money, I believe, should be put into the system in the ordinary course of the decision making that you do. Pension obligation bond proceeds for us are really no different than any other earnings of the system. Now, they may come all in at one time, and we may want to talk about dollar cost averaging or whatever methodology for putting the money out. But we're not going to specially treat those proceeds unless, of course, they so far exceed what we ordinarily earn and have been earning that they have a special impact on the fund. I don't think they will have a special impact on the fund. Over time, they will, because they will prime the pump for the future. And if we're lucky to continue to surf these strong capital markets early in the receipt of that money, it could set us towards a much stronger funded ratio going forward. We had this big presentation today, very helpful on amortization, but amortization, and Bill, I'm going to beg your indulgence because I'm going to, on behalf of the board, I'm going to identify entirely as a layman here, but I want to make a distinction for the board. The amortization schedule is a methodology. It's not part of the actuarial assumptions that are core to how we fund the system and project future benefits. As I say, those assumptions that we make in the ordinary course are the core things that we do actuarially. They are expectations and predictions of future city hiring, future ratios between how many active employees we have and how many retirees, and therefore the cash flow implications of that, mortality rates, how long we'll be paying benefits in the future, expected rates of return. All of those things are completely unaffected by the proceeds of a pension obligation bond. The amortization schedule is a methodology that allows for smoothing and taking volatility out of contribution rates. That comes at the end of the process. We don't start with contributions and reverse engineer back into all of our assumptions. So contribution rates, the impact on contribution rates, and how we can mitigate volatility through the use of an actuarial methodologies like the amortization rate over time. That's the end of the board's process, not the beginning of the board's process. And I'm going to take one exception just to highlight this. Bill, on slide 32, I think it was, at the very end, you say you were going to recommend that whatever we do, that we set the amortization in the first year to not exceed what the city is presently paying in contribution rates plus their POB debt service. And I want to suggest to you that we should not let that tail wag the investment dog or the assumptions that we make. If that's the result, I think that's perfectly fine. But that's not we don't skate towards that puck in setting all of the other assumptions and creation of how we actuarially fund the system. Perfectly fine if that is the end result. But as I say, the board has a fiduciary responsibility to assure the actuarial soundness of the system, and the employer's contribution rate is derived from all the other things that we do, both from an actuarial standpoint and an investment standpoint. And once we get those things set in place, then we can use a methodology like the amortization schedule to nibble at the edges and take the edges off of the impact to the plan sponsor and to the employees. So my message to the board is, let's learn more about what the city wishes to do, intends to do. I think that work session is going to be extremely helpful to this board to understand how much are you talking about? Is the money going to come in all up front or not? Is it going to come in over time? How will we take it in? What assumptions should we make about the future? As we get to better funded status, should we take risk off the table? And what does that mean? I think Council Member Davis raises an enormously important question for our board, which is, does it make sense from a prudent stewardship point of view that as we exceed 80, 90% funded, perhaps with the help of POBs as well as good investment returns, do we, as a policy, start taking some of the risk off the table so that we can assure our employees and the plan sponsors of less volatility and less risk going forward? And maybe we get to full funded, we fully annuitize the plan and never have the risk of underfunded liability again. Wouldn't that be a marvelous goal for this fund? In any event, as we pointed out in our memorandum to you, the law recognizes that you have substantial discretion in setting all of these actuarial assumptions and methodologies going forward and making investment decisions once you have a full set of facts to consider, to deliberate over, to do the if-then proposals. You have a lot of discretion given to you as trustees of a public pension fund in order to shepherd the assets of the system and assure the soundness of the system. So let's gather as much information as we can. We're not in the decision-making mode quite yet on these things, but the message I want to leave you with today is ordinary course. Take in whatever is being proposed, put it into the system that you already have demonstrated talent and experience and success in stewarding this plan over the last several years. And in that context, in that broader context, you'll make the decisions that are appropriate for whatever comes in terms of proceeds from a pension obligation bond or investment earnings, whichever they may be. until we know a little bit more directly, it's very difficult to discuss every possible scenario that's out there. So let's get some more information when we have our meeting with the city council. That will be most informative, and we can take it from there. Happy to answer any questions that you might have from a legal standpoint. And I'll turn it back over to you, Mr. Chairman, to take it from here.
Thank you, Council Leaderman. And so are there any questions from trustees or other stakeholders?
I may be jumping the gun, but I'm just wondering, should the city go ahead to decide to issue, to what extent would our legal counsel be working in concert with the cities in terms of just the reviewing of the documents and disclosures?
None whatsoever.
We would be sort of a passive recipient of data going forward.
That's correct.
Any questions or comment from the public? All right, thank you again, Council Leaderman.
Thank you.
We'll bear your remarks in mind for certain, for sure. Let's move to the next agenda item. Okay, we have discussion and action on the CIO compensation, which will be followed thereafter by discussion and action on CEO compensation. And I know that Trustee Chandra was hoping to jump in and make some comments here, but it appears that he is still unavailable.
He's not available, Mr. Chair, no.
Okay, well, we will proceed. So as we all know, the trustees discussed the performance of both CIO and CEO at our last meeting. As I understand it, should not in open session discuss what the specific ratings we gave to these employees were, but we can discuss the compensation. The CEO and CIO have both been given their official feedback and their official write-ups for the year. And so now we are in the task of discussing what compensation to tie to those reviews, performance reviews. I do receive some talking points, going first to the CIO, the current CIO annual salary. And I do have to just give an aside that I find this entire discussion in public to be very, very personally difficult and untoward, but nevertheless, that's the process we face. I'm sure the other trustees feel similarly. The current CIO annual salary is $307,207. This is well within the current position annual salary range of $240 up to $322. In addition to the $307 and current salary, our CEO also receives 5% of his current salary as non-pensionable pay, which is considered outside the salary range. So it has nothing to do with the salary range. I know that our sister board, Police and Fire, has already discussed these compensation for both CEO and CIO. And of course, we have to come to an agreement between ourselves and with the other board in setting the final actual number. And I believe what the police and fire have discussed is in view of the fact that it's been a fairly extraordinary year, I think extraordinary both in terms of our performance of investment returns, as well as our performance and operationally under extremely difficult and unprecedented conditions, that they believed an increase at the very top of the range was merited, but they did not specify an individual number, and they suggested that the CIO receive something in the range of 5 to 10% increase, with a bias towards the upper end of that range. So with all that said, I open the floor to the other trustees to add their input. I don't know if CIO Polani or CEO Pena would like to comment on this item at this time. But if you do, please proceed.
Mr. Chairman, as you had mentioned before, this is a very uncomfortable discussion, and I'm just going to shut out my video and mute myself for now.
Okay, I'll take that as I can't bear to look.
And I will echo those words from CIO Palani. This is a discussion for the board to be had in public, and we stand ready to answer any questions if there are any, and obviously leave it up to the board to decide publicly. So thank you very much.
Mr. Chairman, may I make a comment?
Please.
Thanks. I think it would be helpful for the board if we have available both the components of the compensation, which are the base building and the non-base building amounts, and then maybe some context in terms of what increases to both of those came in the last year or two.
Harvey, you're cutting in and out. It's hard to hear you.
Really?
Yeah, I wasn't getting it all. I'm sorry.
Can you hear this?
Yeah, that's better.
I'm sorry. So I was suggesting that maybe we give the board some of the current salary, both from the pensionable and non-pensionable amount, and the types of increases that have been granted in the last couple of years, just to put some numbers to help the board understand any further proposal going forward. If that data is available, I think it's there.
Well, I think I did address some of that. I believe the board voted on a 5% merit increase last year. Of course, these numbers come on top of the COLA, which has already been assigned as of June 30th at the end of the fiscal year. For the CIO, the current annual salary existing is 307,207, and that is within a range for the position of 240 to 322, 355. And so it is an increase off of the 307 that we are now discussing. In addition to the 307, we should be aware that the CIO receives an additional 5% of that number, 307, or whatever the new number will be, which is a non-pensionable salary compensation. Is there other data, Harvey, that you were hoping to?
Could you just clarify one thing, Spencer? I'm not sure if I heard you correctly. The range for this role starts from 240 to what level?
322, 355.
So it's
322,000.
It's a 3 points. It's not just a low and a high. Am I hearing it right?
No, these are dollar figures.
It's a range.
So
240,000 to 322. But I have a question.
I heard a third
Um,
number. That's why I'm trying to get clarification.
Well, I get the current salary is 307,
Mhm.
which is between a range of a low of 240,
Mhm.
which is possible for this position, up to a high of 322, 355 to give the full complete figure.
Oh, 322, 320,000, 357. Okay. That's why I
Exactly.
kept hearing it. Thank you.
So the
240
CIO
from
is below
240 to 3.
maximum,
Okay.
is below
Does that
maximum.
include, so I have a question. I'm a little more knowledgeable about city pay. Does that include the 3% COLA that Unit 99 got? So that would have increased the range.
But
Yes, let me address that,
Okay.
Chair Horowitz. Yes, Trustee Jennings, it does include the most recent range with the COLA increases in July.
Okay.
So that's, and then on top of that, there's obviously there's the 5% non-pensionable. And as you know, as the city provides increases, if an increase takes you to the top of your pay range, then obviously that's what you receive. If for some reason the increase goes beyond the top of the range, then you will only go in terms of salary to the top of your range. Anything beyond that is actually made available to the employee in a one payment. That's right.
Yeah,
That's right.
like a bonus.
Yeah, that's
So, okay, but the range is 322. And just to reiterate this, is that there is a cost of living increase that Unit 99, and that's what the CEO and CIO are in, which is 3%. And then there's an MPP, which is the personnel rating that we have done, and they have both merited an increase to the 5 to 10% that we as a board can give them. And so this will, if we were to give Roberto, just to play the numbers, a 10%, that would take him beyond the range. And that would just mean that that additional amount, let's say 8,000, would be a one-time bonus. It would push him to the end of his range.
Conceptually, that is correct. Although the ranges are a little different. The range is a little higher for the CIO than it is for the CEO, but conceptually, what you explained, it is correct. Yes.
Yeah, for the CEO. That's what Spencer provided. He didn't provide the CIO numbers yet.
No, CEO your numbers yet, but
Yeah.
I will.
Oh, we're doing the CIO now?
We're doing the
We've
CIO.
always been on the CIO.
Oh, I'm sorry. I wrote CEO. Okay, so that's the CIO. All right, so for the CIO, that's what it is. So as a trustee, since I do tend to understand the city process, and I was on the bargaining committee for the employees that they both pursue, it is a difficult process on how we pay our city employees, and we don't really recognize our city employees to the level that they should be. And I feel very strongly about that. And Roberto and Prabu do an excellent job. And if comparatively in the outside of the city, would be making probably far more than they're making now. They have done a stellar job. They have taken us to a level that we are extremely happy and pleased with. Prabu certainly has taken us to earnings and advice that the board implemented, but with his guidance. And so I do believe we should go over the 5%. I think we should go within a range between the 5 and 10. You know, that is my recommendation. I mean, I would, you know, it's a difficult thing to throw this out and see whatever, but I certainly would go over 5. I'd probably go with, you know, like 7.5 or something like that, just to, you know, throw it in the middle. But I am certainly someone who can be convinced differently. But I think that's what we're being asked to do. So that's my 2 bits. Okay.
And just to be clear, the 5%, this is not, a city prescribed number. This is the range that police and fire have established at their board. And so if we were to go outside that range, we would need to go back to them and renegotiate a new number.
Well, I
So-
thought they did. I listened to that, and maybe Roberto can give us more update, but I believe the last little bit I heard them say is that I think they were recommending between like 7 and 10% or whatever, and that they would stand behind that. I do want to let everybody know that for the MPP, what was negotiated for the other employee, the people who are not Unit 99, was if you are outstanding, you could get a 2.75% increase. And if you were commendable, you could get a 2.5. And that was something beyond what they normally get. That was a one-year negotiation that was hard won and brought in a state mediator in order to do so. But that is not Unit 99. And that is not the position of our CEO and CIO, because that goes to the board to make those decisions.
Right, all that is completely correct. I just wanted to clarify the source of the 5% number. Does not lie with the city. It lied with our sister board. And they did, in fact, we're leaning towards a 10% increase for the CIO and a 7.5% increase for the CEO. So we have, I guess, one input from Vice Chair Jennings about what the CIO increase might be. Any further discussion from the other trustees on what they are thinking here?
Well, I think it has been an extraordinary year in terms of both the pandemic and also the subsequent investment performance. We're certainly in a much better position now than we were a year and a half ago. And so I would wholeheartedly support giving Prabhu as much of an increase as we can.
I'd like to add that the performance by the CIO and really recognizing the full team. I mean, it's not just about the total performance, although, 29.2%, we're punching way above our weight. We're beating most of our peers, and I think we beat a lot of the largest plans out there as well, within the context of a plan that is relatively conservative. So, the mandate was hit a bunch of singles, keep us steady, and guess what? We got a home run. So that, along with the amount of risk control and overall administration, and keeping the team, I think, motivated and performing at this high level, are all things that are just very unique and deserve recognition and reward. I advocate for a 10% compensation increase for the CIO.
Well, I also agree this has been an outstanding year, and certainly it's about the performance of the entire team and even the trustees in our judgment. But we are only deciding the compensation for the CIO and the CEO, so that is the relevant metric we are dealing with. Given the comments I've just heard, would someone like to make a motion for a specific increase percentage?
I motion that the CIO compensation be increased by 10%.
And do I hear a second to that motion?
I will second that.
So there's a motion on the floor for a 10% increase. Is there any further discussion on the part of trustees? Any comment from the public? We will take a roll call vote then in order of seniority. Trustee Orr?
Aye.
Trustee Keller?
Aye.
Vice Chair Jennings?
Aye.
And I also vote aye. Passes unanimously. CAO Polani, you can turn your video back on. And now we come to the matter of CEO compensation. And let me read out some of the data facts there. I believe we also voted last year for a 5% increase to the compensation for our CEO. His current annual salary is $275,598. This is for a position that has a salary range of $209,000 up to $297,000. And just like the CIO, he receives an additional 5% annual compensation, which is non-pensionable pay. And he also, in addition to that, receives an annual auto allowance of $4,200. So he is also not at the top of the possible range of compensation. And I think in discussions, again, between both boards, he, without specifying a specific rating, received very favorable performance review this year. And I believe the police and fire also suggested a range of 5 to 9%, which they would be comfortable with, leaving the heavy lifting to us once again to specify an exact number. And I think they were sort of centering on a number of 7.5%. So with that, I will open the floor to any comments from trustees or any other stakeholders.
Okay, I'll speak up again. So I think, again, given everything that's going on, given what Roberto did to deal with the pandemic, to deal with the staffing issues, I mean, everybody had to deal with that. I mean, it's not like the other directors within the city did not, okay? It's just that his role is very critical, handles quite a lot of financial responsibility, and keeping us legal and on par. We've had 2 trustees that, have left, he's had to kind of oversee and keep that going, go through the whole investment piece. I mean, so given that, I would throw out a recommendation of 8%.
Comments from other trustees? Trustee Keller, please
I was
go
going
ahead.
to say that I certainly agree, Trustee Jennings, that this has been an extraordinary year, and Roberto is just has greatly added to the plan and to the financial stability of the city through his leadership over the last year. And given the police and fire had indicated a range of 5 to 9%, I would actually be much more in favor of recognizing his leadership and giving him the full 9%. Go to the top end of the range.
Okay, to be clear, they did suggest a range of 5 to 10%.
Oh, 5 to 10? Then I'm sorry. Then I would go 10. Roberto has a lot of experience in managing underfunded pension plans, and just like CIO Polani, if he were to go to the private sector, he could be making a heck of a lot more. And I don't think this is a time where we would want to give him any reason to leave.
Okay. Trustee Orr?
Thank you, Trustee Keller. I'll just add to that, which is, I mean, I'm going to echo everything else everyone else has said. Roberto's really been running this, steering the ship. And I guess my sense is that the role relative to some of the other key city roles is just as essential, obviously. And so I think having that compensation be commensurate to reflect some of the other deputy, the city manager levels and the like, as well as dealing with this diverse array of challenges, be it litigation, funding, launching of the system, the member benefits, communications, and the pass system, all of that, I think has to be reflected in the compensation that we award him this year, which I support at 10%.
Okay, given those comments, will I hear a motion for a specific compensation increase?
I would motion that we increase his compensation by 10%.
And do we have a second for that?
Second.
Very good. We have a motion on the floor for a 10% increase for our CEO. Any discussion? Any comments from other stakeholders or the public? Hearing none, we will have a roll call vote. Trustee Orr?
Aye.
Trustee Keller?
Aye.
Vice Chair Jennings?
Aye.
And I also vote aye. The vote is unanimous. And let us put this to bed for another year. All right, we are moving on to committee reports. The investment committee last met in August. I believe the chair is not present. Trustee Orr, Trustee Kelleher, do you have anything you would like to comment on from the IC meeting?
I do not.
Nothing from my end.
Okay, I believe. Do we need?
Chairman, if it's okay with you, I can give a quick update.
Okay, please.
So we did have a meeting in August, and we discussed, in the Senior Investment Officer Jake Kwan gave an overview of public markets, and Beres did a quarterly update of risk.
Okay.
Those were the two items that were covered.
I see. All right, thank you. And receive and file the various minutes. Do we need a motion and a vote on that, or?
Receive and file will be fine, Mr. Chair.
Okay, so we receive and file. Move on to the governance committee. We had a meeting.
One has their hand up.
Oh, I'm sorry, I couldn't see that.
B. Beekman.
Hi, thank you. Blair Beekman here. Thank you for the meeting today. I've been listening, and it's been a good learning experience for myself. This was a time of minutes approval. I thought I could make a few closing comments. I have to be getting to another meeting, the Sports Arena Authority meeting. If you can be patient with myself, just a few thoughts. I thank you for your report on issues of China and international issues way back at the beginning of this meeting. It was very much needed. And, you know, I think it's important how we address the future of the COVID vaccine this fall. I hope it can be a process where we learn to better talk about it. We have to prepare students for possibly taking the vaccine coming up. I think there can be a language to do that. This has an important purpose to this meeting. Sorry about that. But try to quickly conclude. I think I'm a person who tries to offer the concept that we have to be considering the potential of upcoming natural disasters in the Bay Area and how that works with your balancing your economic plans. Good luck in how to do that. And if you're aware of any natural disaster events in the next few years, hopefully that can be of help in myself mentioning it and how you can judge what you guys need to do at this time. I thank you to the words of Deb Davis, trying to balance out how to work and look through 10-year plans through 1 year incremental or every other year incremental ideas. I thought that was some interesting thinking from herself. It may not be the fully accepted way to work, but it was interesting to hear. And to conclude, just a thank you that I feel there's police overtime issues are becoming a more everyday conversation between community and city government. And Oakland has given some good examples to really address the future of police overtime issues that, and I just wanted to mention at this time that we're actually thinking about the concept and working on it. And hopefully that can be a reminder here at this time. Thanks again for your patience in my speaking at this time. Good luck to the rest of your meeting. Thank you.
Thank you, Mr. Beekman. Now, if there are any other public comments or hands raised, I cannot see the hands raised when you're sharing the screen, or at least I don't know how to do that. So if there are no further comments, I'll proceed with the report from the Governance Committee. We did have a meeting September 9th, and we did discuss modifications and proposed modifications to the board education policy. And if we can bring up the attachment under item 52C. We made some modest changes to the existing education policy. First of all, we recognize the fact that much of what had happened previously in offsite meetings and committee in conferences or learning is not necessarily held in a remote physical location. Much of it is online now. We detailed further some of the concepts that we would expect and anticipate a trustee, especially new trustees, to master. And of course, this is not a comprehensive list. There are so many details to master, but certainly understanding the actuarial issues, which we delved into at length today, and investment asset allocation, and including the concepts of mean variance. One of the more significant changes, if we roll to the next page, was the suggestion that we offer new trustees the possibility of a mentorship with an existing board member to help get them up to speed, to help give them some guidance, insight as to what's going on. We all know what it's like to be a new trustee, and you're dumped into the deep end of the pension pool. And maybe this is a method that can help ease the transition for future new trustees. It is something that other pension plans have implemented. This is at the discretion of the new trustee, so it's something they can make them avail themselves to, but is not necessarily something they must do. And let me scroll down and see if there are any further changes in the policy. We also updated the appendix just to indicate some of the in addition, before we get to the appendix, we suggested that the retirement system management sort of check in more frequently with the new board members to make sure they're coming up to speed and they're feeling satisfied with the level of knowledge they are acquiring and their ability to deal with the issues before the board. And the appendix was updated to include some of the more common courses that we are taking right now and suggesting we take, particularly the ones from Calipers and SACRS that I believe many of the trustees have completed. The old listing had a bunch of programs that some, in many cases, no longer existed or weren't necessarily as pertinent as the ones we do commonly use. So with that, I don't know if there's any discussion. We would like to hear a motion to accept and approve the new board education policy. Are there any questions?
A motion to accept.
I'll second the motion.
Okay, any discussion? So we'll have a roll call vote. Trustee Orr?
Aye.
Trustee Keller?
Aye.
Vice Chair Jennings?
Aye.
And I also vote aye. It passes unanimously. Next, we have the Audit Committee. Chair Keller, would you like to report?
Sure. So Human Bassini, our internal auditor, presented a member termination audit. And it's things look pretty good. They're working very hard on tracking member terminations.
Okay, so no action required here. This is all receive and file.
Yes.
Very good. And moving on to the Joint Personnel Committee, it appears the last meeting was some time ago.
Yeah,
right?
Mr. Chair, so yes, the last meeting was April 30th. We're probably going to be trying to schedule a meeting sometime later this year. Twofold. Number one is the former chair of the Joint Personnel Committee, who was a trustee of Police and Fire, actually resigned to the board. So the Joint Personnel Committee have to elect a new chair for the Joint Committee, which happens to be the only real joint committee of the boards. And two, oddly enough, probably starting in November, the Personnel Committee wants to start working on the review process for the fiscal year ending 2022. So I suspect that we may be scheduling a meeting within the next 2 months or so.
And that will be a little bit tricky because the chair of our board sits on the JPC, and we have already 2 existing members on the JPC. And we know that with our current roster of only 5 trustees, we cannot have 3 members in attendance at that meeting.
You are correct. You are correct. And so I was thinking twofold. Either hopefully by then we have your new appointee for the active members, which will make your board 6 trustees, which would allow you to sit 3 members at the committee. Or you are correct, if you still have 5 members and we happen to schedule a meeting before you get to 6 members, then you are correct that maybe only 2 of the trustees from Federated could attend the meeting to avoid having creating a quorum for the full board. You are correct on that. So we'll keep that in mind.
Okay. All right. Moving on to agenda item 6, education and training. If there's any questions or comments about the various opportunities here. And see if there are any future agenda items we need to discuss. And any public or retiree comments. Hearing none, I believe we are in adjournment.
Thanks all.
Thank you.
Thank you, everyone.
Recording
Happy New
stopped.
Year Day.